Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. Nothing should come between you and your favorite restaurant. Those who believe in this idea must be a happy lot, as government-operated ONDC, it seems, is picking up, and the prices of your favorite dishes are coming down. Those ordering food on it are unable to hide their excitement and are hitting social media platforms to express it. With delivery fees and some other charges gone, the food is now 20 to 30% cheaper when compared to established food delivery platforms. So should Swiggy and Zomato start to worry? Will ONDC's considerably cheaper deliveries deal a blow to their business? Debarga Sanyal flips through the menu to look for the answers.
Mind blown. Ordered food from ONDC via Paytm. Same restaurant, same dish, bill is 25% cheaper than Zomato. This was tweeted by Nitin Agarwal, the CEO of Taurus Oro AMC. Agarwal's reaction isn't unique. Food aggregator platforms Swiggy and Zomato are facing stiff competition from government-backed non-profit platform Open Network for Digital Commerce or ONDC, which is offering users cheaper prices for the same food items. Users have already taken to social media platforms to report the massive differences in prices. The price difference did not count, however, for the discount coupons offered by Swiggy on the baseline prices of food items. Applying these discount coupons narrows the gap in prices. But the coupons are not available for all restaurants. The online food delivery space is currently a settled duopoly. Zomato is the top player in the market with a 56% share, while Swiggy commands a 44% share. This is as of Q4 of FY23, according to analysts at HSBC. The current market leaders reportedly charge higher commissions of around 20 to 25%. Commissions on ONDC, on the other hand, are much lower at around 3 to 5%. But how is ONDC able to provide the same items at almost half the price? What's giving this platform the pricing power?
ONDC was put in place by the government to sort of replicate what NPCI, the National Payments Council of India, did with the mobile or the payments ecosystem, with the UPI. So I think fundamentally it's meant to be a disruptor. The fact that unlike some of the other players, they can actually play around with their margins. They're actually set up as a not-for-profit. Therefore, for a food vendor, he's able to retain a much higher percentage of margin. We all know that food vendors, in a manner of speaking, are held hostage by the big players like Swiggy and Zomato. I think what ONDC is hoping to do is actually go directly to the restaurant and really reduce the margins dramatically. So therefore, consumers get the benefit of that lower pricing. And therefore, we're seeing a lot of these, these kind of big differences in price between what a consumer buys off the ONDC platform versus, let's say, what he gets from a private e-marketplace.
ONDC is in its nascent stages. Swiggy and Zomato offer a larger roster of restaurants to choose from. Moreover, restaurant partners on the network deliver orders using their own delivery fleet, which can be slower than traditional food aggregator platforms. ONDC also lacks any app of its own, and customers looking to order food need to do so using either the Paytm or Magic Pin app. The market leaders Zomato and Swiggy, meanwhile, have invested extensively in user experience, tech-led innovations, and efficiency drivers, including timely delivery, customer support, etc. On the other hand, ONDC acts as a direct bridge between consumers and sellers, and it is not limited to just food delivery. It can also be used as an e-commerce channel to compete with Amazon and Flipkart. Through Magic Pin, ONDC is fulfilling more than 10,000 orders a day. The company had joined the network 2 weeks ago, scaling from less than 1,000 orders to the current number. So, will ONDC be able to break the duopoly?
So the positive for the Swiggy, Zomato, and the Amazon, Flipkart is that the usage experience is seamless. They control the entire value chain, right, from end to end. On the positive front for ONDC is the fact that therefore they're able to get the best price because the intermediary, in a sense, is cut off. They're disaggregating the system, right? So it will always be, shall we say, price advantages. However, whether they're able to replicate the steep learning that the e-commerce platforms have gathered over the years they've been in business, the smoothness of the customer interface, the kind of background they have to your purchasing patterns, to the kind of likes that you have, that will take some time. The ability to seamlessly and intuitively know what the consumer wants, I think that advantage stays with the private e-commerce players. The pricing advantage, the freedom of choice, stays with ONDC.
Experts point out that ONDC has been designed to be a disruptor in the e-commerce and delivery market space. Zomato and Swiggy therefore will have to evolve rapidly if they are to maintain their dominance on the market. Even as Swiggy recently started charging users a platform fee of 2 rupees regardless of the order size in a bid to generate additional cash corpus and rein in expenses, experts believe that ONDC's lower prices will force the delivery giants to slash their rates as well. Either way, it seems the customers are likely to be the biggest gainers.
Struggling with losses, Swiggy had recently appealed to its Swiggy One members to share food and not passwords. Following Netflix's footsteps, it amended its membership to restrict the privilege to 2 mobile phones. Moving on, what if you do not have to remember scores of passwords for all the subscriptions and accounts and could log in using your fingerprint? This is essentially what Google aims to do with rollout of Passkeys. Google is not the only one to launch Passkeys. Microsoft and Apple have done the same in the past few years. It is generally accepted that passkeys which use biometrics, patterns, and pin locks are more secure than passwords and convenient too. So, are we heading to a world without passwords? Tushar Verma unlocks the puzzle.
The blogs, shopping websites, social media accounts, or OTT subscriptions that you cannot live without all need a user ID and password. Passwords are not just a hassle to remember, but also a ubiquitous vulnerability across technologies. In a world of powerful computers and artificial intelligence, no amount of special characters or length can guarantee password security. That's where a passkey comes in. Google, in its recent blog post, termed it as the beginning of the end of the password. Passkeys allow users to log into their Gmail accounts the same way they unlock their mobile devices. This includes PIN and pattern locks or biometrics such as fingerprint or Face ID. Passkeys are resistant to online attacks such as phishing. This, Google says, makes them safer than two-factor authentications. In the past few years, both Microsoft and Apple have launched their own version of Passkeys. Let us understand from Deloitte India's Anand Venkataraman the technical differences between Passkeys and passwords.
The basic difference between a passkey and a password has been there for a very long time. It is something that we know as a shared secret with somebody who we give it to, right? Most of the cases, it's going to be the server on the other side or the application on the other side, which has what we know and we authenticate ourselves. That's a password technology. But in passkey, there is nothing that is actually transmitted. Everything is done through a cryptography across 2 devices. So basically, you register yourself with your mobile phone, which is typically the device that all of us uses. And based on that, pure device authentication, we are able to authenticate to an application or a service online. So that's a key difference, and nothing gets transmitted. The one that goes back is a response to a challenge that is posted, which is signed by the cryptographic key that we already have. And that is unhackable so far.
When you type in passwords, the verification takes place in servers in unknown locations around the world. This makes passwords susceptible to online attacks, like phishing and brute force attacks. Experts say passkeys are safer because they verify the login details in the user's device itself and use public key cryptography. According to Google, since passkeys are bound to a website or app's identity, they're safe from phishing attacks. Although Apple and Microsoft lead the way in passkeys, Gmail is the most widely used email client in the world today, which is used to sign up for multiple other subscriptions. This essentially means that with Google's launch of passkeys, there will be a higher rate of adoption. But will this accelerated adoption lead to better security and less online attacks?
What typically happens in a password, we need to understand that as well, is that we put in a username and then a password. And this is then sent to the end service, which could be an application or a banking application, whatever it might be. Typically, when phishing happens, they kind of divert and they take that username and password, and then they are able to use it on the legitimate side. In case of passkey, once you are registered using a mobile phone or any other device, there are multiple options. There is a public key encryption that stays with the service provider, and the private key is stored within your mobile. Nobody else has your mobile. And what happens is, by way of a challenge that comes, it could be a QR code that needs to be scanned to basically validate that you have your mobile phone with you. And that answer or that QR code which is scanned is getting signed or encrypted with your private key.
Tech giants Google, Apple, and Microsoft have developed support for their passkeys in collaboration with Fast Identity Online Alliance or FIDO Alliance. FIDO is a global authentication standard based on public key cryptography. Its board-level members include giants such as Amazon, American Express, Alphabet, Intel, Meta, and others. With passkeys being adopted, is there a possibility of a world without passwords? Here's what Himanshu Pathak of CyberX9 has to say.
At this stage, it is quite uneasy to say anything like that, because the main thing is adaptability of technology. How many applications are going to be adopted with this technology? Okay, Google is adopting it, partners of Google will be adopting it, but will Twitter be adopting this technology? Will Facebook be adopting this technology? So it depends upon how the market reacts and how people are moving towards that technology, to this passkeys and all. If the market accept this, then of course the password thing will be eliminated.
While passkeys are seamlessly integrated and are more secure, experts say users will still have to remember their master passwords. However, it is believed that the number of passwords required by users will decrease significantly. It also remains to be seen if all platforms on the internet will be willing to integrate passkeys into their systems.
Meanwhile, Bengaluru, that houses offices of tech giants like Google and Microsoft, is now breathing easy. Campaigning for Karnataka polls ended on May 8th. So how will markets react to the outcome of this high-stakes election? Puneet Wadhwa brings the answers.
The high-pitched campaign for the May 10 Karnataka polls is over now, and the results will be out on May 13. Analysts believe that the outcome may sway the markets at best in the short term. The other key domestic factors which may affect the markets in the short to medium term include the progress of monsoon, falling rural demand, corporate results for the March 2022 quarter. While the street will prefer that the government at the centre keep important states under its fold, but a different outcome in the Karnataka polls will not derail equities for long, analysts believe.
Markets prefer the incumbent government at the center to have politically important states in its fold. So naturally, the markets would cheer if BJP is able to form the government in Karnataka. If that was to happen, we could see a decent upmove immediately post the exit polls, which will be followed by a stronger momentum post the declaration of the results. However, if BJP is unable to form the government, the markets could see a temporary correction and then possibly get back on track, as the other logic will come into play, that the electorate votes differently in assembly elections versus general elections. So I really don't see the markets getting derailed for long, even if the elections go against BJP.
Besides the domestic cues, eyes will also be on the global factors such as interest rate trajectory of central banks, crude oil prices, movement of the dollar index, and geopolitical situation, which analysts believe will be trend deciders for the markets. That said, calendar year 2023 from here on is peppered with state elections, which includes Karnataka in May, Madhya Pradesh and Chhattisgarh in November, and then Rajasthan in December.
The factors which will guide the markets going ahead would be the earnings, being the year end would be an extended session, Karnataka election outcome, monsoons which are due in a month, and the crude oil prices. Globally, issues such as recession fears which continue in US and Europe, as well as the banking crisis. Markets now seem to have taken the Russia-Ukraine war as a new normal.
G. Chokalingam of Economics Research and Advisory 2 suggests that the Karnataka Assembly polls can, at best, have a minor sentimental impact on the markets in the short run, rather than deterring their overall course. As per the analyst, markets are unlikely to be impacted significantly post-Karnataka election outcome. The state accounts for only around 5% or 28 seats of the total Lok Sabha strength. Even if the BJP loses power, but manages to retain even 40 to 50% of its current strength in the state, markets will believe that the objective of voters in an assembly poll versus Lok Sabha elections differs quite significantly. Today on May 9th, the market is likely to remain range-bound amid lack of global and domestic triggers. Apollo Tyres, Indraprastha Gas, Lupin, SRF and Castrol India are some of the companies that are scheduled to announce their March 2023 quarter numbers today.
After the markets, let us shift our focus to state-owned companies which are grabbing eyeballs. The government recently granted Navratna status to Rail Vikas Nigam Limited or RVNL. But ever wondered what are Navratnas and Maharatnas? Tariq Ahmed decodes it for you.
Central Public Sector Enterprises or CPSEs are companies that are controlled by the central government. It means that the government will have a 51% or more stake in them. There are around 100 such CPSEs in India and they are classified into three categories: Maharatnas, Navratnas and Miniratnas. Ratna is a Sanskrit term for jewel. Let us start with Maharatnas. Maharatnas are the most coveted public sector companies in India. A central public sector enterprise will be given the status of Maharatna if it fulfills a set of conditions. It should be listed on the stock exchange. It should have an average annual turnover of over 25,000 crore rupees or more during the previous 3 years. It should have an average annual net worth of more than 15,000 crore rupees in the last 3 years. And it should have an average net profit of more than 5,000 crore rupees during the last 3 years. And the company should also have a global presence. Maharatna companies enjoy some autonomy. A Maharatna CPSE's board of directors can make equity investments in financial joint ventures and wholly owned subsidiaries. But these investments are subject to a cap of 15% of the CPSE's total net worth and a maximum of 5,000 crore rupees in a single project. Currently, there are 12 Maharatna companies in India. Coal India Limited, Bharat Petroleum Limited, and Gas Authority of India are some of them. But to attain this Maharatna status, a CPSE should be a Navratna. But what is a Navratna company? To be a Navratna, a CPSE should achieve a score of at least 60 out of 100 in selected performance indicators, including net worth, net profit, the total cost of production, total manpower cost, cost of services, capital employed, and PBDIT, or profit before depreciation, interest and taxes. And there should be 4 independent board directors in the company. It should have a Schedule A status and have obtained excellent or very good MOU rating in 3 of the last 5 years. A Navratna company has the financial autonomy to invest up to 1,000 crore rupees without seeking approval from the government. These companies are allowed to invest 15% of their net worth in a single project or 30% of their net worth in a year. With the latest edition of Rail Vikas Nigam Limited, there are 13 Navratna companies in India now. Hindustan Aeronautics Limited and Shipping Corporation of India are other examples. Mini Ratnas have 2 categories. In order to be considered as a Mini Ratna Category 1 company, a CPSE must have made profit in the last 3 consecutive years, and the pre-tax profit should be 30 crore rupees or more in at least 1 of the 3 years. And to be in the Mini Ratna Category 2, the companies should have made profit continuously in the last 3 years with a positive net worth. Currently, there are over 73 CPSEs that are considered as Mini Ratna in India.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Rail Vikas Nigam Limited was granted Mini Ratna status in 2013. It has implemented several projects, including doubling and electrification of existing lines, construction of new lines, and gauge conversion projects. That's all for today. Catch the next episode of the morning show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.